Sounds good, everyone. Ron and I go way back. We've worked with S&L Farms for a number of years. We're always happy to get to come here. At Lighthouse, we refer to this as the prime rib meeting, so we know what deadline we're up against here to keep this moving and whatnot. So we've had several Lighthouse speakers over here, but I'm happy to be back again. Basically, three things we want to do: just talk about market outlook, that weird feeling you're maybe feeling now that you're not accustomed to and maybe a little afraid of. That's actually optimism, that we have that for the first time in 3 years. But with that comes some responsibility. What do we do now that we have decent margins and whatnot? Talk about some things to do, strategy, kind of example to tie it all together. And along the way, just we'll sort of answer questions, anything we want to get into, but we'll move it right along. I like to just start with, anytime I give a speech, I've been to this crowd before several times, go way back and whatnot, but it's worth just, who is this talking to? Most of us are strangers in this room right now, or I'm stranger to most of you. You probably know each other. And I'd like to just share a little bit about who Lighthouse Commodities is, who I am, because that informs what we're about to share, and it gives you some insight to where is this even worth listening to and paying attention to. So we're an independent grain advisor, but we're also a grain trader, very unique wrap in that. So we don't just, we come to you as a Lighthouse client with here's our recommendation, and then we're actually trading that grain. We're accountable start to finish. We've traded about 260 million bushel of grain since we started, actually well over 1.6 billion in sales now. This year we'll market about 65 million bushel of grain. We'd be one of, if not the largest independent grain company in the state. Our business model involves planning, which we'll touch on today, what our margins are. It involves analysis. We do all of our own internal analytics at Lighthouse, so you aren't hearing something I copied from another slide myself. We've got a director of risk, we've got quantitative analysts and 2 software engineers, all of our own thoughts, all of our own analytics, hedging with Lighthouse, cash trading, and logistics. We've got full wrap of basically everything that would go into what you have to do on the farm to market your grain. You have to plan, you have to know your margins, you have to analyze the markets, you have to make a hedge, you have to set basis, ship that grain. On behalf of our clients, when we work with someone, that's all part of what Lighthouse brings to that client. And got a little over 20-member team now. We're continuing to grow. Right at 1 million acres, give or take, depending on what you guys get planted this spring, is how much we market for. So just to give some context of Lighthouse and some of these thoughts that we share and whatnot, and unique business model at Lighthouse, no upfront fee, no per acre fee, no per bushel fee, no write us a check in January and we promise we'll do a really good job advising you on the markets. We're the exact opposite. We don't get paid anything until you do, and we get a percentage marketing fee. So that ties us all together. That's why we've invested hundreds of thousands of dollars into the quantitative analytics that inform our decisions, et cetera, all because we're in the same boat you're in on marketing and whatnot together. So that's who Lighthouse is. I just share all that just to inform. That's where these thoughts are coming from that we're about to unpack next here. So we're at an interesting point in Marcus. I want to share a quick personal story as a way to kind of anchor into what you need to ask yourself in these markets. So I'm big into fishing. That's what I would be doing anytime I'm not working. I try to work just enough to be able to spend all the rest of my time fishing. And we have a cabin out in Secaucus, and we've got a goal. I've got a personal goal forever to catch a 30-inch walleye out of there. And this winter through the ice, that finally happened in mid-February. It was about this fish on screen is about 30.5 inches. Came through the ice, right by the cabin. Really exciting thing, and I was just pumped. I actually, in all seriousness, have not been that excited about anything in several years and whatnot. And so I shared this on our family text thread, and I've got teenage daughters. They bring a lot of heat on this thread. They're actually kind of bullies to the rest of us in our family, but they were actually quite supportive. They're like, wow, way to go, Dad, that's a huge win. Lots of positive vibes coming on this thread. And then my wife, in the middle of this text, it said, this picture is my personal best walleye, over 30 inches, biggest walleye I've ever caught, a lifetime of fishing. She texted back and said, is that big? But that's a good question to ask ourselves when we think about the markets, because most of the time as farmers, we're thinking about one thing in the markets, a picture we saw on Twitter, whatever the headline, etc. We need to be asking ourselves, is that big in the context of everything else that's going on? So that's kind of something to just anchor with. And so here's what's been happening in the markets. These charts are a little outdated, they're a couple days behind, but it's essentially the same thing. So if you look at your new crop futures, if you look at December corn, November beans, they actually chased up to mid 490s, mid 1170s. That's the highest price for the new crop contracts in a little over 2.5 years. So you're actually higher on new crop corn than we got at all in 2024 and again in 2025, and in both corn and soybeans. So again, that weird feeling, that one that we vaguely remember but we haven't felt in a while. There's some optimism here. There's some opportunity that can go with it. Alongside that, part of what's driving that, certainly, what's driving a lot of the headlines and what's driving a lot of the farmer discussion, is this big? This is what's right in front of us, is this unfurling war situation in Iran. And so, and I should preface all this by any comments of mine in any context are solely to this selfish goal of what does it mean next for the markets, not unpacking the broader, is this a good thing, is this a bad thing, how does this fit in everything else. But so if you look at this conflict through a prism of what does it mean for our grain market, certainly the situation there, and as it's escalating, and about 20% of the world's oil and a big chunk of the nitrogen fertilizer passes through this Strait of Hormuz that they've been, that the Iranians have been successfully halting shipments, or halting most shipments, or halting U.S. or U.S. affiliated shipments and whatnot. They've also been on both sides of the conflict, in Iran and in the Gulf states that surround it. They've been attacking oil, nat gas, fertilizer infrastructure as part of the overall war effort. So this is really bullish for energy prices. You've seen that already. Crude oil actually has wrapped from its start before the conflict started to its high a week ago Sunday, roughly 10 days ago. It had rallied somewhere in the neighborhood of 80% in just a few days. Interesting side note in all this, and this should inform some of our risk management decision making. Interesting side note, crude oil on Sunday night a week ago traded in a larger range Sunday night than the previous 3 years combined. You had a almost $40 a barrel trading range just from where you peaked out at Sunday night to where you bottomed out at early in the morning that morning. So it's very volatile and whatnot, but price has rallied. I think there's one natural extension of this that you're thinking, and not incorrectly, not unreasonably, that you're thinking about on the farm side. This is causing nitrogen fertilizer to surge in price. Urea's rallied. Urea's almost doubled at the Gulf since this conflict started. And this is just ahead of Spring's. This is right as you're going to the field. And if I don't have my nitrogen fertilizer locked in on price, maybe this drives some decision making. Maybe I'm not as inclined to plant corn. Maybe I'm switching acres. Meanwhile, I look at 1150-ish soybeans and say maybe these acres go into this. So this is not a bad narrative to have, and we'll come back to that in a second. But if you set that aside, it's good to just pause for a minute, because this is important. There's a thread we've latched onto from our clients, our people we're talking to every week, and I assume it's more broadly held conviction among farmers in general that this event is bullish until it ends for grains. Like it's just bullish. Just every day that this conflict goes on, grain prices are going to keep going up. Don't you know how bullish this is, Dave? You don't have a lot of history. A lot of our analysts, any analysis, what you do on the agronomy side too, the seed side, it's just looking at what happened in the past to inform what might happen in this situation that's similar to the past. You don't have a lot of analogs to this, but you have one pretty useful one, again, in the context of just the markets, not weighing in on the broader geopolitical implications. We had something similar happen almost 4 years ago to the day when Russia invaded Ukraine. And that was, you're literally, farmers were farming around spent border rounds that spring. You're literally fighting in the breadbasket of Eastern Europe and some of the most productive farmland in the world. huge implications, especially as it relates to wheat and corn. And that entire war premium was priced in about 2 weeks, I guess is the takeaway on this. If you were in a much different commodity environment then, but in about 2 weeks, you priced in that war premium, and that has not been, that war is still continuing. There's still heavy fighting there going on now, and you've not had a meaningful market move tied to that in the space since then. So if you use that as an analog, we would expect standing here today, as it relates to grains, most of the war premium is already priced into this. What happens from here on grains is probably not driven to a huge singular degree by the situation unfurling in Iran. So I think a other takeaway on that, to just keep in the back of a guy's mind, back of a person's mind, is you're just collectively, certainly in the US and collectively in the world, huge incentive to not let energy prices spiral out of control. I think you can agree, all politics is self-preservation, almost without exception. There's very few true statesmen out there, and you will get throttled in these midterm elections if the energy prices stay as high. They'll do whatever it takes for that to not be the case. So again, bringing this back to grains, 2 weeks ago we should be hugely bullish on grains based on the situation starting. Standing here today, we've probably priced in most of the impact of that Iran situation. That's based on the analogs we can look at. That may look silly a day from now, a week from now, a year from now, but that would be our analytics takeaway, is that you've already priced in most of this war premium. So if my marketing plan is, I'm gonna stay long, I'm not gonna sell any of my grain for the next 6 months, no matter what, because this Iran situation, and I think that's big. That's my 30-inch walleye. The analytics say that alone is probably not the biggest driver for that. Okay, so let's switch gears to what else is going on in these markets. We've got the other factors that would play into this, because those factors are actually much better than they've been the last 2 years. Separate of the Iran conflict, the outlook on grain price is much better regardless. So Ag Forum outlook, end of February. This is not planning intentions, this is not survey data, this is statistical modeling, but this is what they said we should expect for corn and bean acres. Corn acres down about 5 million, 94 million, go all the way down to that bottom number, 11.4% stocks to use, down pretty considerably from 13% stocks to use this year. So that 5 million acre drop roughly in planting, stocks to use 11.4%. Remember that number, that'll be important later. That's still bearish. That alone is not going to give you above $5 corn, but it's a lot closer to where you need to get to have a big rally. So planting intentions coming up in, what's today, the 18th, 19th, 12 days, next Tuesday. We'll find out for sure. I think it's important to note on these intentions too, those surveys were being filled out ahead of, or they go out in early March, so right as this was happening. I don't think you would see a lot of like impact of acres change tied to the skyrocketing urea necessarily. Another thing in planting intentions in the Delta and like the south central part of this country, cotton and rice margins are terrible. They're about as bad as wheat is. Rice is actually worse than wheat. When that's happened in the past, there's a couple million acres potentially that are going to be switched out of them that flow into corn and soybeans. So we'd be a believer of maybe 94 on the low side on corn acres. We don't think it's going to be a lot lower than that. On the same token, Ag Forum, corn lost 5 million, beans are picking up 4 million. Math seems reasonable, can get on board with that. We would definitely skew higher on this bean acres number. That Delta situation, really poor cotton and rice margins, that should pull some acres in. And then to whatever, even prior to the urea situation, there was a lot of incentive. If the guy's in a tough spot cash flow wise, if there's bankers saying, hey, we don't want to lay out as much for this crop, there was a lot of incentive to switch to soybeans, and you had pretty good soybean prices through the winter. But if we take this 85 million at face value, it takes you to virtually unchanged carryout on soybeans, 350 million bushel. That's a soybean carryout, and none of these numbers will be the same when it's all said and done. These are just dark, but assuming that's a reasonable expectation today, you've got the exact same carryout you had a year ago. A year ago, soybeans traded between, you know, $9.60 and low $11 futures, and that actually fits this stocks to use range really well. So basically, take all this, again, we'll get to actual acres next week, and then we'll go try and plant them after that. But if we take these Ag Forum numbers, these are balance sheets that are similar in the case of beans, tighter in the case of corn than a year ago. They're closer to where they need to be really bullish, but they're not, on face value, they're not bullish today. They're just a lot closer than what we were a year ago. So you've got some things happening on the demand side that are incredibly useful. One of the things about this administration, they've been, at least in their rhetoric, really supportive of biofuels. Part of how we fix this ag situation that you're in, and part of it's been impacted by tariffs, part of it's just oversupply, years of good production. Part of it is we're going to reassert our commitment to biofuels. So you finally got some clarifying language on 45Z tax credits that should unlock now everybody that's set up to produce advanced biofuels can move forward with these projects. They can generate the tax credits, and this is one of the worst kept secrets. There's been several leaks on the 2026 renewable volume obligations, and without getting too wonky, what this is the EPA comes out every year, and they're usually late on this. Sometimes it's after the year's ended, but they've said here, under the renewable fuel standard, here's how much of each class of fuel, corn-based ethanol, renewable diesel, etc., that you have to make, and their renewable diesel number that was leaked last week is quite a bit more than what the trade is thinking about. This is why soybean oil has been running, why canola has been running. Crush margins have gotten very good again. There's going to be strong demand, and when you put those two together, the 45Z language, they also have said, hey, we're not going to let you do anymore, or we're not going to allow what happened last year where all this used cooking oil, in quotations, came in from China, from overseas, and that was the feedstock produces biodiesel. But no, it's got to be North American, it's got to be North American products, so primarily canola and soybeans to produce oil, soybean oil, canola oil to be feedstock, produce all this extra biodiesel that we're saying we want in 2026. Parallel to this won't be an immediate impact, but the administration is at least saying, again, rhetoric-wise, get us a year-round E15 bill that everybody can live with, that crude oil can live with, or that big oil can live with, the ethanol industry can live with. And basically, one of your barriers on ethanol is you can only use it half of the E15. You can only use it half of the year in most of the country. North Dakota's an exception, one of the few. But if you got the year-round E15 waiver, you at least have the framework to where when ethanol's cheap compared to gas, you could blend all the way up to 15% instead of 10%. This would unlock huge additional corn demand, allow more plants to be built, etc. Again, this would not be an overnight thing, but it's part of, if this happens, part of structurally. So your demand side of this, you've got some promising stuff on biofuels demand on the horizon. Also on the demand side for corn, at least, when corn has been spending a couple of years down in the low $4 futures range, the global demand has been huge. I'm sure you're following, just we're on pace for record exports, and we're still running 150 million bushel or so ahead of that pace on export demand. You're actually, despite the huge US crop this year, world corn demand is still outpacing supply. You actually have a relatively tight world corn stocks to use, and in China itself, you know, there's, you know, you can kind of regard with some skepticism, if not outright cynicism, their state provided statistics, and they have projected several years of a perfect stair step of record crop production, but their corn prices are surging. They're at contract highs right now. They've surged way more than US prices have. That arbitrage, that what this corn is worth right here in Barnes County today versus what it's worth landed at a port in China is to where it works again for the first time since 2021, 2022. So there's this strong global demand for corn, and particularly in China, despite years of policy saying we want to be feed grain self-sufficient, their demand is still outpacing, their feed demand, their livestock demand is still outpacing on the corn side. So So you've got some good structural things there. Also just worth noting, early March is a weird time for grains to be peaking for the year. In fact, you've never had March, is actually the only month of the calendar that you've never had a yearly high made in. So this would be a first if that ends up being the case. Normally you follow a pretty predictable seasonal on grains. You tend to rally through the winter, through the spring, into the early summer, and then a strong tendency to make highs in that window. So seasonally, if you just said, I don't know anything else that's going on in the markets, but today I look at my calendar and it's March 19th, should I sell all my grain today? Seasonally, I'd say no, that would be the worst move you could ever make. So you got a strong seasonal on your side. So that's kind of the setup on the positive side. You've got a little tighter balance sheets than a year ago. You've got this Iran situation. Some of that's causing just an overall inflation trade. You've got strong demand on both the feed side for corn and on the biofuel side for everything. And you've got a normal seasonal pattern that says grain should rally in early summer. Here's some caution signs alongside that. First up, during this rally on corn and beans, and corn hasn't even rallied that much per se, but it's rallied 7 or 8% from where it started to where it is now, call it 30 cents, give or take. During that rally, what I'm showing on the screen here is the May-July corn spread. That actually got worse, and then that's incredibly unusual. A good healthy rally is cash driven. I can't get corn bought, so I'm raising my basis, and that's causing the front month to narrow to gain versus the back month and eventually the board. This is the exact opposite. This is a rally that's led by those macro conditions, and the cash markets are saying, oh, we don't need all this grain. We got plenty of grain. So you're seeing basis backing off, spreads widening, more carry come into that. This is a big warning sign as far as the ability for a rally to continue beyond this, because ultimately cash markets win out, and this is a warning sign. There's a couple other warning signs. Some of our proprietary analytics at Lighthouse, one of them is just we've done a lot of modeling of the price range that a commodity trades in relative to its stocks to use. So if you've got 13% stocks to use like we do this year on corn, anytime we've had 13% stocks to use, this is the range we tend to trade in, for example. If we've got 8% stocks to use, then this is the range up here. Something unique that happened on the highs a week ago Monday, you had corn, beans, and wheat all in the top 25th percentile of price to stocks to use at the same time. The highlighted white on this chart shows other times that's been the case, and you can see just by looking at it, that's typically been associated with pretty substantial price break, because not surprisingly, all your grains are like in the high end of what we would expect for their price relative to their stocks to use. So that's a warning sign. And then a big warning sign, that the chart on the screen here shows managed money, the speculator, the large speculator that's buying and selling grains. Their behavior heavily influences price. It's the single biggest, if you had no other thing to look at, just looking at this commitment of trader data for managed money would inform tremendously what you're going on. And they have been huge buyers of grain in this rally. You're back to near record net long position across corn, beans, spring wheat for the managed money crowd. They're huge buyers of this. So that's very associated. If you scroll back to these other peaks, almost all of them are associated with seasonal tops. There's very few instances where that isn't the case. So these are our warning signs in the market here where we're at right now. So to tie that all together and what it means and so forth, if we look at this chart on the screen, shows going back to 2008, the rally from Jan 1 price to whatever high that December corn made, rally from Jan 1 to harvest. What was the biggest rally that it had? There's a couple of years there where there was no rally. Your Jan 1 price was literally your highest of the year. Those were transition years. That 2024 is an example, and the other one was 2013, where you were transitioning from a bull market. Otherwise, every other year featured at least some rally. most of the years had a seasonal high somewhere between May and July. All but 2 years had a high after May 1. So those big bars, those bars that make farming fun again, those bars that are what we dream about every night, why we don't want to sell corn at $5, those are the bars that got you to $7, $8 corn. In every case, those rallies were with much tighter stocks to use. Every case but one, they were with much tighter stocks to use. The smaller bars line up much better with what we have this year, and you see rallies of anywhere from 7 to 19% to your seasonal high. Not many examples of a rally less than that, not many examples of a rally more than that. So when we just unpack all that data that we just went through, you can make a pretty strong case that your rally to some sort of high on new crop corn, new crop beans should be somewhere between 7 and 19%, just based on this historical data. Where we were at on our highs a week ago, Monday, was roughly 11% on beans and 9% on corn. So you're actually, even on that rally, you're in range of what the analytics say should be a high. So if we look at all that, there's only one exception where you had everything we just talked about, and you went on to rally way more from where we're at right now. There's only been 1 year where that case. That was 2008. 2008, you had a similar setup. You had cash markets that were getting worse during a rally that started in the winter and kept going. It started way before the winter, but it continued through the winter. And the reason was because you had runaway energy prices and you had huge upcoming biofuels demand. So there's some similarities to this year, to 2008, but 2008 was way more pronounced. You had 2 billion bushel of new corn demand coming online later in 2008, et cetera. But that would be if you said everything we just talked about here, no, we still think corn could double in price. Your scenario that would support that would be 2008, and that was built off of crude oil prices much higher than they are now, even a structural energy production problem. That was pre-shale revolution, et cetera. It wasn't tied to a war necessarily, and then again, it was a biofuel story, but way bigger than this year. Otherwise, there's not a lot of precedent for a huge rally beyond today's prices on the data that we looked at now. So let me just pause there, and we'll quickly run through an example. But before I do, just questions on the markets. Who has any just questions, differing opinions, etc.
How would it, if you're unmarketed, what does that mean for old crop going into the summer? Is where price rally?
So yeah, and this in a year like this with big carries, you don't have inverse at all on corn and a very small one on soybeans, and so your conclusions are real similar for old and new crop. And the takeaway here for old crop that you have in hand is you definitely should be, if I'm looking at this analytics case and saying, here's all these, we've done this rally already, we think we've priced in the war premium just based on the time we spent on it. We're in range of where our price to stocks to use modeling says we should stop out at. And I've got this grain in hand, and if it's corn, I had good corn yields, if not huge corn yields. I got money. If I haven't already, I should be doing some sort of hedging here, some sort of marketing for summer. That would be our takeaway. It would be that slight chance that this is like 2008 and we keep rallying is not worth me betting my whole crop on it when I'm at this level and whatnot.
About the basis side, the basis is slumped up with this. Would you walk around?
Yeah, so I think, and I don't know this for certainty. So one thing on basis on corn, North Dakota corn supply this year was, so the last 2 years were records. You had around 550 million bushel of corn produced in North Dakota. It was about 150 million more than we'd ever had, and we handled it okay. You still had fairly normal marketing. This year was closer to 700 million bushel, essentially double what your biggest crop in North Dakota ever was prior to 3 years ago. So some of this is, to some extent, we're in uncharted territory. You just flat out have more corn than you're set up to actually market and merchandise in this state and whatnot. All that said, you're getting down, if you take like July corn at 75 under into a shuttle, 75, you're getting down to where that should be the floor on basis, because you're getting to where you can truck that corn almost all the way to Lethbridge. You can put it on shuttles and go east to Ohio, like they're a lot tighter in corn. You're getting down to where that should be the floor. So that's actually good, that ties into a paradigm on marketing we're gonna hit anyhow on the next slide. So a lot of times, good marketing comes down to number one, get the first decision right. Number two, don't compound it by if I did the first one wrong, making another bad decision. So if I didn't set basis prior on corn, I'm probably not necessarily rushing to set it now, unless my local market is something better than that still and whatnot. I think you're kind of at the floor on basis. I would not expect a big recovery, I think, if you get back into that, local elevator, 55 to 60 unrated, that's probably the ceiling, because they're just playing too much corn in the state and whatnot. Soybeans are the opposites for what it's worth. You actually had a smaller soybean crop in state than you did a year ago between the acres and then just the yields were so disappointing across most of the state and whatnot. So soybeans, you're back to that. I mean, you're pretty respectable soybean, at least at crush plants and whatnot. If you're tributary to a crush plant, which if you're in this room and you farm, you definitely are. You're either very close to one or right in the middle at two, which is even more enviable. So the soybean one is a whole different story. There'll be all kinds of good outcomes on soybean basis for the balance of the year, but corn, that would be my best takeaway today, that you've fallen enough that a better play is just get those hedges on, get the hedge in July, and either wait for basis to improve, or if basis doesn't improve, you'll see that July SEP carry widen out considerably, and you can pick up that carry and at least move it later summer. But getting into that sort of stuff, I could kill way too much time on. We like talking about that stuff, but too detailed maybe. Yeah. So any other just market questions in that vein? Yeah.
Would that make canola market kind of bullish, because local crush could be more canola? Soybean's a much larger crop.
So that's a good one to, maybe that's a good to flip ahead to the margin slide to, so canola. So here's the canola story for most farms, and I included here in the valley, canola is by far the highest margin. In the valley, or here, corn is probably still better, but you go west at all and then go north at all, canola is just, if you're thinking of growing canola, we've had more guys stepping into canola than ever. This is a good year to do it. I think we need to be actually pretty careful on canola. If our client base is any indication, canola acres are going to be up drastically in North Dakota. So if you're sitting here and growing canola for the first time, you probably need to be thinking about, did I plant a quarter of it? Did I plant 10 quarters of it? Do I have canola bins? Can I even hold this? Canola's got to be dry. You can't move it to crush, at least if it's not dry and whatnot. And your local elevators here are not necessarily super aggressive on canola. So the good news is you can go out and sell it today and lock in a phenomenal profit on canola. I think that, I guess where I'm going, I think that canola market's going to be a mess come this fall if we get any kind of good, because the acres are going to be up so huge. And then you guys haven't grown canola here for 20 years, so we don't know what happens here, but like in the central part of the state, north central, the yields have been just huge the last, it's not uncommon to get 2,800 pound canola in Botno County just on a normal year and whatnot. So if I'm growing canola this year, we've had a mantra that this is corn and bean country, that's what you should grow, and that's still overwhelmingly, if ever there was a year to do canola, it's this year, but don't sleep on it. You've got chance now to sell phenomenal futures and historically normal basis for harvest and post-harvest delivery. I would not sleep on that. I think that canola market's gonna be really pluggy this fall if we get any kind of normal crop. So, but I do think it's a very good decision to grow it. Just maybe don't do the farmer thing of, oh, canola's so great on paper, we're gonna grow it, but we're not gonna market any of it, and then we're just gonna, by harvest, it's just, just a whole different paradigm and whatnot, so.
So, Dave, across a big wide area here, it's Cargill and ADM for markets. What do you got, Belleville, West, where else is there something like?
So you've got, and here, it would be Cargill and the canola moves from northwest to southeast, that's the natural flow of canola. Overall, besides these two plants, ADM and then Bunge and Altona, so straight north here, they actually pull quite a bit of, and then CHS and Halleck, they pull later into the year and stuff, we'll send quite a bit of canola that way. Those are your end users, so that's something good about canola. You have good, you actually, as a percentage of the crop, you have the most end use for canola locally, in state or in the region as anything that we grow and whatnot. But I honestly am not sure what'll happen. So if you get like up to Botno or Langdon or that area, those elevators are fairly aggressive on canola too. So you've got a market clearing bid and stuff. I don't know how that'll play out around here. I'm guessing these shuttles that are designed to just push corn train after corn train are not going to be real enthused to show an aggressive canola bid. So I think you got to be thinking my canola needs to get pointed to one of these crush plants at some point. Is probably the case if I'm sitting right here.
So your guys are traditional canola growers, I mean, what percent of the crop they sit on? It's been convenient year, the acres are low, people haul right into the other one.
So, and canola, some people don't, so canola's actually, it's exchange traded, it's on the Winnipeg, it's on ice, but the Winnipeg, whatever location and whatnot, so there's some quirkiness, it's traded in Canadian dollars, but you have futures and basis on canola, you have board carry, you have normal basis patterns. Canola normally pays a pretty good return to storage. This year was huge, like huge return between, this is my November futures, and if this is my March is way higher, and then this is my harvest basis, is my March. So you definitely can, there's return to storage on canola, but the same as always, you still want to be thinking about getting your basis set. Basically the same examples we're going through on corn right now, making sure we're getting basis set out forward. So, and then the biggest thing, canola is a little trickier to store than like corn or soybeans. You gotta make sure it's dry. You gotta have the right floors in the bins and whatnot. But it's definitely a crop that works to just we as a percentage of the crop that's grown in the state, we're actually biggest in canola. Lighthouse Market's almost 10% of every bushel of canola grown in the whole state and whatnot. And we merchandise that just like we would corn, beans, etc. Just hedge targets, hedge to arrives, roll the, what should I move because what has the most return on storage and what should I store and stuff. So
What percentage of yours goes off the town line next to the elevator, right?
and that's hugely client specific. If we generalize overall though, about 25% or so on the rest gets stored. I can tell you, if I'm sitting in this room and farming around here and I'm growing canola for the first time since when I said I'd never grow it again after growing it 20 years ago, I'm thinking a lot about, I want this sold to just move off the combine. I've got terminal markets right down the road that are showing me a good price. I'm gonna have a ton of corn bushels to deal with. I got a small percentage in canola. I'm probably not screwing around. I'm probably thinking in that scenario, just get it moved off the combine or pretty close, just because it ties up neatly. And like I say, all this futures basis carry stuff you can throw it out the window and just sell West Fargo's cash price for September delivery and guarantee yourself a pretty nice profit as long as you get a crop. So that's enough on canola, is my take. That's still not but it does make sense to grow. Any other market questions, or we'll wrap it up with just a quick example of how we make decisions, or any other market? Ones that these slides, maybe it won't let me go backwards. There we go. Just lightning quick here, but just corn, this takes fertilizer price at the market and you're still showing decent, and this would be better here. This is obviously more of a central North Dakota, way lower corn yield than you would expect in Barnes County, but nice return. Soybeans, positive, not huge, but so just kind of frames up where you're at. Even with this board rally on soybeans, you're still just a small positive return. Nobody should be even thinking about wheat, even with the board rally. You're still not even to break even on wheat, so. It's good to be in front of a crowd that can laugh at the wheat slide. We still have a lot of Central North Dakota clients that just insist on growing wheat, and it doesn't work good. So, just last couple minutes here, I just wanted to tie this all together. So everything we just shared, it still comes down to how do I make a decision? And I think you have just two main things to think about here. So if you could be making incremental sales again, if you can get yourself to the point of saying, which I've got myself very much to the point of, I'm not the single smartest grain trader that's ever lived. I probably won't sell all this grain at the top of the market. If you can make that leap, then you say, I'm gonna split this into incremental sales, and at the highest level, when I think about those sales, I'm trying to do them through some combination of time and space. So space as in, I sold a little bit of corn here, so my next target space-wise is here. But if I don't hit my space target, I need to hit a time target so that I don't end up getting in backlog. So I'm gonna get 10% of this corn sold at $4.90 futures or as good as I can by this date, etc. And we'll couple slides of just how to get that done, or how Lighthouse does at least. The other big takeaway, if you can just avoid ending up with grain in town unsold. If you use corn now as an example, I mean, if I had corn in town at harvest and didn't sell it, even with a 30-40 cent board rally, if I've been paying storage since harvest and basis is now 25 cents worse, I'm worse off if I priced it today than I would have been at harvest. And I've got all that carrying cost. I've got all that working capital I didn't get, interest costs on it and whatnot. So if you did nothing else other than said, on this farm, we're gonna have grain sold before it gets to town, and we're gonna have a plan for doing it as reasonably well as we can, you would vault into the top echelon of just farm marketers and whatnot. And that some of that involves just, okay, what is my storage situation? How much corn needs to move at harvest? Well, I'm gonna make sure I get that sold at a profitable price when I get a chance to, so I don't get jammed up to where I'm at harvest and I can't move it at all. And just planning some of that stuff out, just all of that makes a huge difference. You know, if we take this example though now, and you said, okay, it's rallying, we're at multi-year highs, Dave, that's when grain's at 2-year highs, that's usually when I get bullish. Like, that's usually when I'm talking about how it's going to $8. How do we get over that? How do we know, is this a big situation? Is this a situation to act on? So at Lighthouse, just when we would tie this all together, we would have that fundamental insight we talked about. We'd have that margin slide that says, hey, I'm making money. The other thing that we do is we've got our quantitative analytics, our price signal, and our market gauge. So if we look at this exact scenario, this is from March 10th, but it's still the same. All those market gauges at the bottom are high. They're saying this fits with selling grain, and we've got a sell signal actually on our price signal chart saying this sells. So now I can wake up and say, you know, fundamentally we know that it's a pretty good, that if corn got close to $5, that's a 10% rally. That's about all we were expecting out of this market. Then we look at that margin slide and say, well, I'm making 100 or 150 bucks or whatever at $5 corn. Well, I'm not gonna go broke making those kind of margins. That fits, that's profitable. Now we can look and say, okay, I've also quantitatively, I've got a sell signal here, I've got high market gauges. This fits a situation where it makes sense to sell. a good counterpoint to this, the Jan Wasby, super bearish on paper, prices collapsed, people are wanting to panic, what happens next? We had a buy signal that day, guys, we're not selling corn here, this would be a terrible time to sell corn, and in fact, we're buying corn, or at least Lighthouse was starting to build a long position, and so if you put those all together, that can get you past, hey, this headline, hey, this war news, we're bullish forever, it's going to the moon, and say, no, this checks a lot of boxes for here's where I would make a hedge and whatnot, and if you do that process over and over again on all your grain that you sell, you've got a real good chance of being successful no matter what the market conditions. You avoid the scenario of I got a bunch of grain unpriced in town in a bear market, et cetera. So that's how we kind of, and then the final, just noting, I'm not going to get into this any deeper necessarily, but just noting in amongst itself, there's a million different ways to execute a hedge. I mean, it can be a hedge to arrive or a cash sale. It can be a min-max contract. A lot of times we will buy calls on a call signal ahead of an expected sale, on a buy signal ahead of an expected sale. There's a million other things you can do inside that make it easier to execute. It's all about making you willing to pull that trigger when something is big, when it is time. So just to wrap it up on time here, I just wanted to, that was kind of the final shot. Any questions in that vein, or on the execution side, or any other market questions of any front? So, yeah.
Kind of back to, market, how tight is soybeans in the state? How do you think the basis will be pretty aggressive into the summer months?
So if you look at the soybean balance sheet in state, you actually, you had about 20 million less bushels produced or supply. When you take your carry in plus your production, you actually have way less than that produced year over year. If you run, a lot of it comes to your demand assumption for what's going out P&W. Like, if you go back a couple months ago to the very good phone call, and China's gonna take 8 million more metric ton of beans, if that actually happens and a bunch of those go out to P&W, this is gonna, it'll be wild, you know, what it means, because you'll run out of beans in the state if those scenarios play out. If it's just on track for what we have on the books already, it's still gonna be one of the tighter carryouts we've had. Where it gets tricky is you've got this old crop, new crop inverse on that these crush plants know how to work really well. So if you carry beans much beyond the spring, you're playing chicken with, like a year ago, their basis dropped over $1 in one day in early June. Those bids rolled from July to November in one day. So you're playing a game of chicken on that. But the carry out, assuming that China doesn't come in and take all these extra beans that they allegedly said they were gonna this summer, you'll firm a little bit more on this old crop crush basis. If they take all those beans, who knows? The way to think about it though is, if I can catch a good, now is the time to catch a good soybean basis on the last old crop beans, because you're gonna get, it's gonna get really high stakes if you hold them in the summer. If you wait one day too long, you may leave $1 or more on the table, because as soon as they buy the last bean they need to, then those bids go to new crop vision. It literally happened in one day last year. It was one day where they rolled. So it's tantalizing to think about, well, if there is an actual counter seasonal Chinese soybean purchase in the summer, how just dramatic that could be while these crush plants are still trying to get covered with this short sort of crop. That's probably just your last little bit of basis risk, though, you should play with that on, because if you get it wrong, you're gonna have significant remorse, versus just, if you watch what happens in the next couple of weeks, you'll have some really good, just bird in the hand type basis. You can sell way better than harvest. Unbelievable amount of carry you earn for holding these beans till now, and we're thinking more in the terms of just risk management. We're in range now where we achieved what we set out to on storing these beans, and we don't want to roll the dice too much on these summer beans. Any other questions? Markets, any front?
Who rolled first last year, the plants or the elevators?
Well, the plants are driving this. Yeah, one of the benefits of, I suppose, from their perspective, there's only handful of crushers that could pull it, everybody rolled on the same day last year. I don't know who went first, I think it was actually AGP, but everybody rolled on the same day, it was wild. So, yeah, but that's the crush is kind of in the driver's seat on the back end of this job now.
And your price looks in.
Yeah, and the thing is, you don't need to fix prices when there's only 6 of you. You just gotta pay attention to what your neighbors do, and you just do the same thing, and so, yeah. You consolidate down enough that there's no need for collusion or anything, there's so few of you that, yeah.
How much insight do you have into when they're bought up? Do you have any indication from them guys?
So, all you have is, you don't, they don't, there's a lot of gamesmanship in cash commodity trading, you kind of read between the lines of, oh, we sold them 1 million bushel of soybeans here, and they didn't back off at all, or while they've been backing off a nickel here, or while they, or they'll say, a little bit of just, oh, we're getting pretty close to covered here, and then they are widening, it's all, you don't ever know with certainty, but some of the just, what they're saying, what they're doing, what their bid structure's showing, and whatnot is kinda all just, you're just piecing together a picture based off that, just based on kind of all those factors, but, it's, always, just after a career of commodity trading, you just assume not to take at face value anything another trader's telling you, because you're usually not telling them it's something at face value either and whatnot, so you're kind of just clues in that nature, but a good overall clue is just what's happening on the front end of the curve and stuff, so like, if I'm selling them beans and they're still not backing off, well, they still got stuff to cover, as opposed to, oh, this thing's gonna carry now from March to July, well, that's a warning sign, oh, we sold some beans, they did back off another nickel and stuff, kind of watching the front end of that curve is a pretty good tell for when stuff's starting to get, close to the finish line, if you will. Right, well, any otherwise, yeah, thanks to Spring Creek and Innovative Ag, this is not just because of the prime rib, although that is part of why, but also just the crowd and the questions. This is one of my favorite meetings every year. I don't do a lot of these